Alright everyone, international investors sometimes may lose money in US real estate market, but this happens not because the market is bad, they lose because they invest in the cities that sound exciting instead of the cities that actually work. And today, I'm going to break down 5 US cities where international investors could be successful while putting money into real estate within the US platform. Alright everyone, welcome back to the channel. My name is Sergey and this is Luxury Living in Naples. So before we jump into the cities, let me explain why my perspective may be useful to you. I live and run businesses in Naples, Florida, one of the most competitive, regulated, and transparent real estate markets in the United States. Every day I work with real payroll, real insurance, real taxes, and real operating expenses. And all of that is not theory, it's true reality, which is full of deadlines and day-to-day stress and operations. So if you are an international investor, whether you are coming from Europe, Latin America, the Middle East, or Asia, this video is about how US real estate actually works when you are responsible for the outcomes. And if this is kind of an honest breakdown is helpful to you, make sure you subscribe to the channel, stay connected, and I truly appreciate you being part of the club. Let's start with Miami. Miami is not just a US city, it's a global capital hub. In many South Florida new construction projects, international buyers represent 30 to 50% of the total purchases. Well, that alone tells you how much global money flows into this market. In practical terms, what does that really mean for investors? Well, let's look at the numbers. We're going to see that condos in solid areas typically trade between 600,000 to 1.2 million, and quality long-term rentals often run between 4,000 to 6,000 per month, sometimes even higher. Well, of course, depends on the rental. Occupancy rates in strong neighborhoods regularly stay above 90%. And now then this, no Florida state income tax, constant tourism and relocation, strong legal protection of the property rights. Miami is not cheap, but it is liquid. Capital moves here even when other markets slow down. This is a truly capital preservation market with upside. Alright, number 2, that would be Austin, Texas. Jobs drive demand. Austin is a city built on employment, not speculation. Over the last decade, Austin metro population grew by more than 30%, largely driven by tech companies, startups, and remote professionals with high incomes. Now, what does it look like on the ground? So, single-family homes often fall in the $450,000 to $750,000 range, while rent typically sits at around $2,000 to $3,000 per month. The key point here is that poor rents in Austin, while people with jobs. Austin also has no state income tax, and it improves net returns significantly. This is why Austin works as a long-term growth market backed by employment, not hype. Alright, number 3, Dallas-Fort Worth. Scale and stability. Dallas-Fort Worth is about scale. The metro area of Dallas has over 7.5 million people, and it continues to grow by more than 100,000 residents per year. That scale creates stability. Here, international investors can often enter at $300,000 to $450,000 for solid rental properties, with rents commonly landing between $1,800 and $2,600 per month. What really makes Dallas work is diversification. Finance, healthcare, logistics, energy, manufacturing, tech, and all-in-one market type of thing. That diversity reduces volatility and creates predictable long-term performance, which many international investors value so much. Well, number 4 is Charlotte, North Carolina, a quiet, undervalued performer. Charlotte doesn't get flashy headlines, and that's exactly why it works. Since 2010, the metro population has grown by over 20%. Property prices remain reasonable compared to its economic importance. Homes commonly trade between $350,000 and $550,000, with the rents often falling in 1.7 to 2.4 to all in 1,700 to 2,400 range. Charlotte is a major banking and finance center, which brings professional tenants and long-term rental demand. It's not hype market, it's a numbers market. So number 5, Atlanta, population engine. Atlanta is a city powered by movement. Every year, roughly 60,000 to 70,000 people move into the Atlanta metro area. People who are relocated need housing immediately. In real terms, homes often range from 320,000 to 500,000. Rents over stay between like $1,800 to $2,700 per month. Atlanta also benefits from massive logistic infrastructure, corporate relocations in industries like film, healthcare, and that. That combination creates a strong rental demand and excellent liquidity. All right, everyone. Now let's talk about key takeaways for you as international investors. Well, here's the biggest takeaway. Successful U.S. real estate investing is not about buying the cheapest property. It is about population growth, rental demand, and legal protection, liquidity, and long-term economic confidence. That is why international investors still place tens of billions of dollars into U.S. real estate every year. So if you are investing from outside U.S., your biggest advantage is patience, and your biggest risk is time. 5 cities we'll cover today are non-trends. They are systems that work. If you want a deeper breakdown on specific cities, taxes, or ownership structures, subscribe and leave a comment, and I'll see you in the next one.